All right, everyone, welcome again. So let's start. First of all, thank you very much, everyone, for joining. And if you're not sure what Prosperato does, then we are a group which is singularly focused on helping people make better financial decisions. Now, for a long time, a small investor has not been able to take advantage of equities as a reliable way of wealth creation. Yeah, skill nahi hota hai, or they lack the time to research. And in some cases, it's a mix of both to varying degrees. And that is why we precisely created Prosperato. Now, on Prosperato, you will find only, and I do mean only, SEBI Registered Investment Advisors who are constantly researching for the next best investment idea that they will share with you. Now, whether your problem was a skill or time, all you have to do is just one guided investment at a time, move closer towards your financial goal. But today is not about Prosperato. It's about all the people who have joined, all the people who are ambitious, all the young and all the ambitious women and men who believe that they can achieve all their personal aspirations through better financial decisions, amongst other things, if I may say so. But एक छोटा सा problem आता है वहाँ पे. As I always say, in India, people have at least done two things. One is they must have played cricket at some point in their life or another. And sometimes in some form, they must have done some investment, either a stock, direct stock. They must have taken a mutual fund, probably a ULIP. But not all of us could become Sachin Tendulkars. Not all of us would become wealthy with investing. But that's not because the problem lies with investing as a paradigm per se. It's not because the problem is that investing is unapproachable to us. No. It's because that most of us lack the right approach. And that is where we have our investment expert, Mr. Dipen Doshi, with us today, who's going to share his experience and expertise on this. Now, if you ask me, I believe it's a bit of an understatement to call Dipen an expert. From all the time that I have known him, I think he's simply awesome when it comes to matters of investment. Now, Dipen holds an MBA in finance from University of San Francisco. As of now, he's the founder of Focus Investing. And he comes with a wealth of business experience in addition to all this. And most importantly, he has been a value investor himself from over a decade. And his approach has been quite simple. And I'm pretty sure at the end of this discussion, you will end up having the same impression as I have. You won't hear a lot of big words and complicated and scary things in whatever he has to tell us. At the end of this discussion, in the next 15-20 minutes, you will realize that successful investing is all about right behavior, right understanding, and right research. And these simple things have made his Dipen's own investing successful to a great extent. And if you want to quantify that, here is it. He has never lost any money in stock markets. And trust me, it's a rare achievement. And now that he's a SEBI Registered Investment Advisor himself, he's able to help his clients take care of their own financial matters and achieve the same degree of success as he has been enjoying himself. But I believe that not all of you are aware of a SEBI Registered Investment Advisor is. So let me just quickly take a moment and bring you up to speed on that one. Now, no points for guessing over here. A registered investment advisor or an RIA is a person and can be an organization as well whose job is to advise people on investing, but it's not just stock markets investing. It can be investing of any kind. It can be your personal finances. It can be your it can be tax related issues. It can be your family office issues, insurance, you name it. And they are not just experienced in this, but they are also legally certified to do this for an individual or an organization. And here's the best part. It's not just empty advice. This role carries a lot of fiduciary duty towards their customers. Even mutual funds don't have that. And the best part that I personally find with this framework is that RIAs are regulated by Securities and Exchange Board of India, shortly known as SEBI, which is a government body and which is the market regulator. And even the most fascinating part is that SEBI doesn't just certify everyone and anyone to be an investment advisor. Their criteria are very, very strict. If you wanted to figure out how strict that criteria is, understand this: as of today, 2021, in India, there are only under 1,700 SEBI registered investment advisors. So yeah, it is a tad difficult thing to be able to do that. So all in all, the person with us today is a money doctor in all practical purposes. So Dipen, welcome. Thank you very much for joining us, and over to you.
Thank you, Akash, for the kind introduction, and a very good afternoon to everyone. So guys, I'll start the process by explaining in brief what we do and what is our research methodology. Focus investing's core investment philosophy is really very simple. We buy great companies at low valuations for the long term and enjoy the compounding wealth effect. Now, the next question would be, what is low valuations and what are great companies? So we remove valuations of all the companies we study and come up with what we call is a safe price to buy. So if we have removed a safe price to buy for a particular company at say rupees 100, and if it is quoting in the share market at say rupees 120 or 125, then come what may, we will not buy that stock because it is overvalued. Similarly, if it was quoting at say rupees 100 or less than 100 at say 90 or 95, then of course we'll buy that stock because it is undervalued or what we call low valuations. Now, what are great companies? Now, I want to be very clear, great companies doesn't mean large caps. In fact, we don't define great companies by market capitalization. So even a small cap or a mid cap company can be a great company. We have our own proprietary method whereby we have a stringent eligibility criteria, and only if those companies fulfill those requirements, then we include them in our list of great companies. So, currently in our universe, we have around 68 companies whom we term as great companies, and we are regularly updating it on a half-yearly basis. So some of the common features or performance parameters which we look for in companies before including them in our list of great companies are management, ethics, and efficiency. So 80% of the companies listed on the Indian stock market have fraudulent or dicey management. So if management is not honest, then वो अपने shareholders को क्या पैसे कमा के देगा, right? So honest management is extremely important. But equally important is that the management is efficient and dynamic, because it is their strategies which will decide how successful and profitable the organization will be. Then all the companies should have a minimum past growth story of 6 to 10 years. And even for future, we should be able to see enough growth drivers or runways for their product or service the company is offering for a minimum period of 5 to 10 years. Then we look for competitive moat. This is a classic Warren Buffett concept where a company has a competitive advantage over its competitors, which enables it to capture or retain market share. And in say a crisis like a COVID, it also enables them to capture more market share. So a competitive moat could be anything like superior quality of a product or service, technological innovation, and it can be as simple as cost management, where lot of companies are very good with efficiently controlling their cost, which enables them to make larger profits. Then we look for brand presence for the product or the service the company is offering, either in the niche regions or pan-India basis. How strong is the brand? Then the other feature is debt structure. Like most of the companies in our list are either debt-free or have very negligible debt on their balance sheet. The reason being that if the company ends up paying more the interest expense on their loans, then that is going to shrink their profits, right? So low debt or zero debt is extremely important. Then we look for positive cash flows. Now, positive cash flows is extremely important because the company can use that surplus money for either their capacity expansion, or they can use their money to give out dividends to the shareholders, or simply exercise a buyback. And then finally, we look at all the relevant financial ratios, the most important being return on equity, what we call ROE, and return on capital employed, like ROCE,
Dipen, not able to hear you.
18 to 20%.
Okay, back.
So, folks, this is in a nutshell. What are the? Can you hear me now? Yeah. So, can you hear me now?
Yes, Dipen, I can.
Yeah. So now we'll show you what are the advantages of our investment strategy. See, now there are several ways to make money in the stock market, but we believe, in fact, very strongly believe that ours is the safest way to generate great wealth. Why is it safe? Because it carries low risk. Why is it low risk? Because you are invested in a great company and not a penny stock. If you show the patience and stay invested for the long term, there is absolutely no capital erosion. Since there is mental peace because you're doing long-term value investing, so you are not exposed to the day-to-day volatilities of the market, so your blood pressure remains steady. It is suitable for all kinds of investors. Doesn't matter whether you are a low risk, moderate risk, or a high risk investor. It is suitable. This strategy is suitable for all kinds of investors. There is absolutely no restriction on the size of the amount you want to use for this strategy to begin your direct investing journey. You can start with as a small amount as, say, 25,000 to 50,000. And as we mentioned before, we have a universe of around 68 great companies, which is ever expanding. So there are always new investment opportunities available on a monthly basis. So all you guys have to do is, whenever you have your funds ready, just subscribe to one of the payment models of Prosperato and get a well-researched equity recommendation for the long term and begin your successful direct investing journey. So now, just to reinforce the safety of our investment strategy and why there is no capital erosion, this is a classic example we are showing you. This is one of the greatest financial crises which happened in the year 2008, when the Lehman Brothers in the US crashed. Now we all know what happened during the COVID era, right? The share market fell by around 40%, and then it rebounded back magnificently. Now, here in 2008, one of the greatest financial crises, the Indian stock market fell by more than 64% in a span of 6 months. So almost 24% more than the COVID era. So what we are trying to show here is what happened to our great companies when the share market fell so greatly, right? So as you can see in the diagram, when the share market fell by more than 64%, obviously our companies also fell for the short term, but in a lesser range, between 22 to 35%. And as you can see, some companies like a Colgate and an HUL, they didn't even fell. In fact, they rose. And the most heartening thing is, within 6 months, 3 to 6 months of the crisis, all our companies rebounded back by more than 60 to 80%. Whereas the not so good companies took a whole 2 years to rebound back, and some companies, in fact, never recovered. So what does this show is that, irrespective of how much the share market falls, the great companies are the least affected and they recover the fastest. To highlight this fact, we'll now move on to a case study. This is my own self-experience. See, I bought Nestle just before the Maggi controversy. Most of you might have heard about the Maggi controversy. The Indian FDA thought that the lead content in Maggi was more, so it created a massive controversy for the short term, of course. But immediately after the controversy, the Nestle shares tanked by 40%. But you know what? I didn't panic because I very strongly believe that I was invested in a high quality, great company. I knew that Nestle is the number one food processing company, not only in India, but across the world. It has the best distribution network. In fact, all its products are ranked number one in their respective categories. So, a small controversy cannot make a great company poor overnight. In fact, this was like a classic Warren Buffett case where a great company was in trouble for a short term. So luckily, I was holding more funds. So what did I do? I bought more of Nestle shares to average my purchase cost. Now, first year, you can see I'm still in the negative, minus 30%. Second year, you can see I'm still in the negative, minus 20%. But both these 2 years, I stayed invested, showed patience, and had this firm belief that I'm invested in a high quality stock. So I'm going to reap the benefits. And came the third year, and I was plus 69%. Uh, that's a CAGR of almost 26%. And I'm till date holding Nestle, and it is giving me a CAGR of 50%. Now, CAGR is what we call compound annual growth rate. So when I say 50% CAGR, it effectively means per annum compounded returns. So in absolute sense, if I had to explain you, if I'm holding Nestle since 6 years, so 50 multiplied by 6, so Nestle is effectively giving me more than 300% returns in absolute terms over last 6 years. So what is the moral of the story? If you are invested in a high quality, great company and show the patience and stay invested for the long term, you are going to reap stupendous returns. Now, all of you would be thinking whether this strategy would be suitable for everyone. This strategy is suitable for all kinds of investors. It doesn't matter, as we mentioned earlier, whether you are investing in equity, dividend, or
Dipen, lost your audio for a while there.
suitable for anyone between say 20 to 50 years age, because it is we are enjoying the compounding wealth effect. Anyone can use this strategy as long as they understand and they are willing to stay invested for the long term with an investment horizon of 3 to 4 years. Anyone who understands that great companies will survive the ups and downs of the stock market, as we showed you in our earlier slides, and are willing to stay patient, then trust me folks, you will reap stupendous returns in the long term. So now we'll move on to the final slide. As you know, we offer investment advisory services where we give equity recommendations for the long term. But in addition to this, we also offer other services. Like if someone wants their existing portfolio reviewed or rebalanced, we can help them with the same. A lot of individuals want to do financial and tax planning to meet their short-term and financial goals. We can help them achieve the same. And in general, any other financial query you might have, whether it is relating to your business or a fixed income instrument or an insurance product, etc., etc., we are willing to offer you one-time consultancy where we can help you resolve those queries. So with that, I would like to thank everyone for joining this webinar. And please feel free to ask as many questions as you want regarding the presentation, and I will be happy to answer all of them. So it's over to you now, Akash.
Thank you very much, Dipen. That was extremely helpful. So if I could simply quickly summarize the key takeaways that people can have from your experience would be: A, it's important to have the right behavioral characteristics in addition to the understanding of the nitty-gritties of investing research. Patience is definitely tested when things go wrong, but being patient leads to greater rewards in the long run. And when it comes to the technical nitty-gritties of it, you talked about things like various financial ratios, the cash flows, the competitive moat, most importantly, the strength and vision and performance of the company management itself. So it looks like it's a combination of subjective, qualitative, and quantitative measures which can help one understand what a good investment opportunity can be. And it seems like a lot of work. Okay, now with that, ladies and gentlemen, over to you. If you have any questions, you can send your questions to me, and Dipen would address them. And meanwhile, while you type your questions, just a quick update. As a little thank you note from us, if anyone wants to subscribe to Focus Investing, which is Dipen's recommendation service on prosperator.com, we are giving out a 10% instant cash discount, and the same is applicable for any of the consulting services that you can take from prosperator.com. Now, Dipen, while people give us questions, let me read out some questions that I have received on the email from people who were not able to join. The first question that I have is, what is the minimum amount with which one can start investing in stocks?
Akash, as I mentioned before, there is no restriction on the size of the amount investment because it is irrelevant, because you are going to, the percentage returns are going to remain the same irrespective of the size of the funds. So, it is very simple. If you are going to earn, say, 20 to 25% return, so if you put rupees 100, you are going to earn 25 rupees. If you put rupees 1,000, you are going to earn 250 rupees. But there is no, restriction on the size of your investment. You can start with as low as 25 to 50,000 rupees and can go as big as 1 crore. It doesn't matter.
And I think the fact that it's a low risk investment strategy that also helps.
Absolutely. Absolutely.
Okay. All right. Next interesting question, and this is the one that I always get, is what are your views on short-term trading, especially how can a person can generate regular returns through investing?
See, short-term trading, we call it gambling. So the stakes are highly, the odds are highly staked against you. Like a lot of the experienced short-term traders who I know who are doing it since 20, 30 years, they say their success ratio is 50% or less. So there is 50% chance that you are going to fail. So I don't know, it really boils down to the individual, whether they want to take that risk for their hard-earned savings. I know in short-term trading, there is thrill, लेकिन मजा के साथ सजा भी है. So whether it's highly an individual's call, whether they want to go for a safety first option with their investments, or they want to enjoy the thrill of the short-term trading, where there is a very high risk of you making a substantial loss.
Okay. I'll just quickly switch to one of the questions that I've received from our participants. Ashish has asked, how can one purchase companies' shares directly?
Directly through the Prosperator model, or he wants to do direct investing himself? I didn't get the question.
I think the question is around being able to do direct investing himself. I think it's a generic question, not relevant to your strategy or Prosperator.
Yeah, the easier, you start the process easily by opening a demat and a trading account. But then it gets complicated, right? You first need to identify the companies you want to study, the sectors, you want to identify the sectors. And once you've done that, then the difficult part starts, because you have to at least, do a proper research and study of the companies, before putting your hard-earned money into it. So it, comes down to the performance parameters or the common features I had mentioned earlier. You have to study each and everything before putting your hard-earned money. When, you need to find out about the management, whether it is honest, whether it is efficient. You need to look at the past financial data of the company. You need to, ask the distributors or the dealers about the product or the service the company is offering. You need to understand, how the brand presence of the company is. Basically, read every literature available on the company, and then figure out look at the financials also, like the debt structure, the cash flows, all the relevant financial ratios I mentioned, and then you can come to a conclusion that these are the companies you want to invest in, right? And then comes one more trickier part. You still have to remove valuations. You just can't buy any company at any valuations. So there are several valuation methods which you might have to use. We use the ROE method, the return on equity method. We use the DCF, the discounting cash flow method. We use the SOTP method. We use the price to earnings multiple ratio method. So there are several methods you need to use, and then you can probably make a call whether regarding which companies you want to invest in. So if you find this difficult and you don't have the time, and this requires a lot of time, it doesn't happen overnight. So the smarter thing would be to leave it to the experts, and subscribe to one of the payment models of Prosperator and get a well researched equity recommendation for the long term, and hopefully start a successful direct investing journey.
Dipen, that has brought on a follow-up question, and a similar question was received to us on an email as well, relating to mutual funds. If someone, direct investing versus mutual funds, and if someone wants to go the mutual fund way, then what should one consider?
See, you can do direct investing successfully as long as you're doing long-term equity investing using our investment strategy, because it is safe, the risk is low, and there is absolutely no capital erosion. But again, as I told you, it's an individual's call whether you want to do direct investing or you can go for mutual funds. But there are 2-3 things people need to be aware of mutual funds, and I'm not trying to contradict mutual funds. I'm just trying to highlight a few points. See, there are right now in the market more than 1,000 mutual fund products. So the investor is confused which product they should subscribe to, because the problem is all the the top performing equity mutual funds don't remain same every year. They are not consistent, right? So to choose the right equity mutual fund or a debt mutual fund for yourself is a very difficult task for the investor. Second is, mutual fund, even if they give you negative or negligible returns, they are going to charge their management fee. It doesn't matter whether they give you negative or negligible return. And third thing is what people probably would not be aware, that they are compelled by SEBI to deploy the funds of the investors immediately, instead of waiting and putting it in an escrow account till they find the right value companies. So many times they end up investing in overvalued stocks. So when you do that, you are not going to get the returns in the long term. So it is going to compromise your returns as well. But again, as I said, it's an individual's call whether they want to do direct investing or they want to prefer the mutual fund.
You know what, Dipen, on this, I saw a meme recently. So there was a scene from Three Idiots where that gentleman is being interviewed, and eventually the interviewers say, "Bhai, salary kitna loge?" So it was on the same thing. So this guy is sitting in front of 3 interviewers, and the interviewers ask, "कि आपका quality क्या है?" And he says, "Sir, मैंने scheme related document एकदम अच्छे से एक word पढ़ा है. I know how you operate." And the other guy says, "Bhai, salary kitna loge?" So yeah, absolutely agreed. Mutual funds, yes, they work. They are easy. They take a lot of efforts from an individual investor, but they have some limitations. They are not bad. I also started my investing journey with a mutual fund, but they have certain limitations against direct investing.
And you, just to point out, you learn a lot in direct investing, which you will never learn in mutual funds.
But if you do it the wrong way, you learn.
Extremely important for any individual.
Yeah.
People learn from the failures, right? Failures teach you. Success doesn't teach you anything.
Okay. Next question, I've again received this from on my email, and this is the last on my email question. This is from Namita, and she wants to know, what all things shall I know if I have to start investing directly into stocks?
I already addressed that question, Akash, when from the chat guy. Where it's a comprehensive process, right? As I said that you first open your Demat trading account, and then you have to identify the companies you want to invest in, because after all, it's your hard-earned money. So you just can't invest in any Tom, Dick, and Harry company. And then you have to study, which requires a lot of time. Study each and every performance parameters which we have mentioned in our slides before, and in one of my other answers too. So I'm just going to keep this short. And then once you have done that, you have to then remove valuations, because you just can't buy any company at any valuations. Otherwise, it will compromise your returns. So the smarter thing, if you don't have the time and the energy to do this, then just leave it to the experts.
Okay. There's a question from Kapil on the demo. So let me just quickly take that. So the question is, can we have a demo of products? So on prosperato.com, you do not have a demo of focus investing, but the way we have designed is, you don't necessarily need a demo, because whatever investment recommendations that Dipen sends, they come through our platform. The platform at all time is giving you a real-time performance information of all recommendations sent by Dipen. You could have a look at return parameters. You could have a look at how the recommendations as a whole have performed over a period of time. And you can also have a look at some of the closed recommendations whose targets have met. So that should give you a fair amount of idea of how this product works. But nevertheless, Kapil, I can always reach out to you separately and I can help you understand more about it. Okay, moving on to the next question. So the question from Chandra: selection of good company in your approach is manual or is it just rule based? Because knowing about the management of a company is very subjective.
See, as I mentioned earlier, it is very much a rule based, because as I told you, in our proprietary method, we have a very stringent criteria, and only if the companies fulfill those requirements, we include them in our list of great companies. So it is very much rule based. It is not manual. And I understand that everyone doesn't have access to the management, but luckily, I've been more than a decade old in this industry, and I know a lot of people in the investment banking industry. So we get first-hand information about the management, which probably not all retail investors will have access to. But so I agree with Chandra. Probably, a retail investor will not have access to the management. But people like us who've been in the industry since a while do get first-hand information about the management, ethics, efficiency, dynamism, etc.
Okay. Next question from Vishwesh, quite an interesting question. It often is on the mind of a lot of people. Is there anything called right time to enter the market? Like currently market is already at high and most of the shares are quite high.
See, Akash, when we are using our strategy, we don't care what the market is in the short term. So we are always looking at what our scripts are doing. So if we find that some of our scripts are at low valuations, then irrespective of whether the market is in a bull run or a bear run, it doesn't matter to us. We will follow our norm and invest in those companies if they are available at low valuation. So for us, the market going up and down is totally irrelevant. It is a macro factor. It will continue to happen every year. And you just have to ignore that. You just need to concentrate on the companies you are invested in. So that's what we do. And that is what our approach is. So if we don't panic even if the share market falls. Yeah.
Okay. So if I understood your answer correctly, Dipen, in a way you are trying to underscore the fact that a company's valuation is unrelated to what the market is doing as a whole. And your approach is to simply look for companies who at any given point of time are not valued at the fair price, and they have better future prospects in front of them, and your approach is to go for them.
Yeah, because as we have also highlighted in our presentation, right? Even if the market falls, the great companies are the least affected and they recover the fastest. So you should not worry about, if there is a fall in the market, and my share prices will fall down. You need to understand that you invested in a high quality, great company, which will continue to grow. It will continue to make greater profits for its shareholders. So the market has to, take stock of it, and eventually, the share price, it will get reflected in the share prices, obviously in the long term.
But then in a way, this is about making a certain amount of commitment to a company, right? So in that case, I'm assuming that when one of such selections, one of such investments go down, it would be the right approach to deploy additional funds if there is a possibility of it in them.
See, it depends. That is why, it is a continuous process. We are continuously monitoring all these companies. We are reading each and every literature available on the companies. We are following up on what the management's next decisions are. So many times there is a possibility in our journey that if we feel that the company is no longer fits our great company criteria, then we sometimes might even exit those companies. And then there will be scenarios where we feel that the company is still on a growth runway and it will continue to grow. Then if there is a possibility when, it's low, valuations are low, and if if you have the funds available, we'll, as I mentioned in our Nestle example, I'll invest more and average my purchase cost.
Okay. And I think that kind of underscores the fact when you said that that good investing is not just about the technicalities of it, it is about the behavior of the investor as well.
And you have to continuously monitor all the companies. You just can't just invest and forget about it.
Yeah, true. Okay. Another question from Chandra. This is more on the subscription model, so I'll just quickly take this. So question is, subscription charges are for yearly basis or on per investment basis? And on Prosperator, will we be getting only advices, and will it be our call to act on the advice? So Chandra, the subscription, we have a couple of subscription models. First, if you want to try things out, or if you have a very limited amount of capital available, then we have something called as a mini subscription. So for 2000 rupees, you'll be able to invest anything between 50,000 to 1 lakh rupees, or maybe more of capital that you have. You'll be receiving about 4 well-researched recommendations for that. If you have more capital to deploy, then you can go for our monthly subscription model, which costs you 2,500 rupees, and that would allow you to deploy even more of your capital funds. If you had a bigger amount of surplus with you, then we also have a one-time subscription, which lasts for 6 months, and that would allow you to deploy an even bigger amount. So depending on how much free capital we have at any point of time, we have all the right models to help people invest in it without having necessarily to make longer commitments. It's purely a very investor friendly subscription model that we have over here. Now, coming to your second question, will we be getting only advices, and will it be our call to act on the advice? Yes, as someone to whom the funds belong, yes, it will always be your call whether you want to act on the advice or not. But if I may just add to that, in my experience, the way we have designed Prosperato, we have always emphasized on getting the right quality to our customers. If we are not convinced in someone, we don't work with them, which means there would hardly be an instance wherein you would not be able to, or you would not want to go with someone's advice. Unless you are not feeling comfortable, unless you are short of funds or something, you would have no reason to not go with the advice.
Just to add one thing, Akash, we are also providing them the rationale behind the recommendation as well, right? Why we are recommending the script.
Oh, yes.
So that helps them in the direct investing journey.
Yeah. So every recommendation that comes, every expert has to provide a detailed rationale as to why a recommendation has been given to an individual. And in addition to this subject, of course, you receive details like when you should enter, what should be the target you should be looking for. But in addition to this, everybody provides that. In addition to this, the fact that you get this rationale, you really get to understand why a certain recommendation was provided. And that, in my opinion, is something that really helps people and helps you make your decision. All right. So that's another question. Mr. Nagaraj, how much is the range of CAGR on investment I may expect? I think, Mr. Nagaraj, what you're trying to ask is what kind of returns should you expect from direct equity investing? Just to confirm my understanding. Okay, so Dipen.
See, our objective whenever we recommend a script is that for the long term is that clients' money should double in next 4 to 5 years. So ideally, we are looking at a CAGR of say 20 to 25%. So we are not trying to sell any magic wand that your money will double in 1 year or 2 years. We are advocating long-term value investing, where we are trying to achieve the objective of doubling your investment in a span of 4 to 5 years, which comes to roughly a CAGR of 20 to 25%. I think he understood the question.
Yeah. All right. I haven't received any more questions, so I'll just give 1 more minute to this in case and someone is still typing their question. And I'll just quickly go through the list to see if I've missed anyone's question.
even if someone remembers any question later on, they can always email, right?
Yes, you can always reach out to us on our phone numbers or email addresses with your questions, and we would always be very happy to help you out with them. All right, so no more questions received. So in that case, let's wind up. And ladies and gentlemen, thank you very much once again for giving us your time over a weekend. And I hope um, this discussion was able to help you in some aspects. And as Dipen said, if you have any questions at a later point of time as well, you can always reach out to us at hello@itmtb.com, or you can call us directly on this number on the screen, which is 7668 59406. And Dipen, thank you very much for your time, and
My pleasure.
quite insightful.
Thank you.
All right. Thank you very much, everyone.
Everyone have a great weekend.
Yeah, thank you. Everyone have a great weekend.